To this explainer. Today, we're taking the incredibly complex, often headache-inducing alphabet soup of Indian school payroll compliance, and we're going to transform it into a clear, actionable, and frankly, human-focused blueprint for 2026. If you're managing HR, finances, or operations for an educational institution, you already know the landscape is shifting rapidly. We're going to break all of that down right now so you can navigate the changes with total confidence. We've got a lot of ground to cover today. We'll be looking beyond the simple salary credit, unpacking EPF and ESIC, touching on professional tax and NPS, and then diving into gratuity and the new wage definition rules. Finally, we'll tie it all back to the employee experience. So let's just dive right in.
Starting off, we really need a fundamental shift in how we view the monthly salary cycle, looking far beyond just the basic salary credit to understand the true cost of education.
You know, it's so easy to think of payroll as just a simple math equation, right? Gross minus deductions equals net. The employee gets their bank notification, and everyone moves on with their month. But if you work in HR, you know perfectly well that behind that single notification is a heavily regulated system of statutory deductions, employer contributions, and long-term entitlements. Managing a school just isn't like running a traditional corporate office, and that changes absolutely everything about your compliance structure. Just think about the massive variety of people working in your school. You've got the principal and senior coordinators, sure, but you also have the security guards, the IT staff, and the housekeeping teams. Depending on their specific role, their wages, and their employment arrangement, entirely different statutory compliance rules are going to apply to them. You simply cannot take a one-size-fits-all approach to school payroll anymore. Moving on to the very foundation of Social Security for your staff, let's unpack EPF and ESIC, the two biggest acronyms you probably deal with every single month. Now, here is a number you absolutely need to have memorized: 15,000 rupees a month. That is the statutory wage ceiling for mandatory EPF coverage under the current framework. While you may hear whispers or reports about this ceiling increasing, payroll teams absolutely shouldn't alter their calculations based on rumors. Always wait for the official government notification. This ceiling is crucial, though, because it forms the absolute baseline for building a retirement corpus over a 10, 15, or even 20-year career in education. So how do the exact contribution splits actually work out? Well, for EPF, the standard is 12% from the employee and 12% from the employer. But here's the catch. That employer's 12% isn't just dumped into one single bucket. It's actually split up. 8.33% is credited to the EPS, which is the pension scheme, while the remaining 3.67% goes to the standard EPF account. Then we have ESIC, the Employees State Insurance Corporation, which provides immense medical care and social insurance. For this one, the employee pays a highly subsidized 0.75%, while the employer covers 3.25%. Just to put that into perspective, for an eligible employee making 20,000 rupees, that's just a 150 rupee deduction for a massive, comprehensive healthcare safety net. When it comes to ESIC applicability, HR teams really have to stay on top of the current wage limits. The ceiling is generally 21,000 rupees per month, but it actually goes up to 25,000 rupees per month for persons with disabilities. And remember, applicability is based entirely on the specific wages and statutory coverage conditions, not just a job title. You can't just assume a driver or front office staff member is automatically covered or exempt. You have to run the numbers for each and every individual. Having covered central Social Security, we need to shift gears a bit and distinguish between mandatory state rules and voluntary retirement choices, specifically professional tax and the NPS. The crucial thing to remember here is that professional tax is strictly a state-level tax. It is not income tax, and it varies completely depending on where your school is actually located. For instance, if your school is in Karnataka, you absolutely must ensure your payroll reflects the new amendments that took effect on April 1, 2026. The state introduced major changes to its portal and compliance processes this year. So if you're still relying on an old PT table from last year, you need to update that immediately. Now, unlike professional tax, which is, just a mandatory deduction you have to remit to the state, the National Pension System, or NPS, is an entirely different beast. It's a voluntary, market-linked retirement tool. Private schools are not legally mandated to offer it, but you can opt into it under the corporate sector model. This is honestly a brilliant way to boost an employee's long-term corpus. A school and an employee can both contribute, say, 5,000 rupees each per month, allowing that educator to build a substantial market-linked nest egg right alongside their traditional EPF. Let's transition over to a benefit that employees usually only truly appreciate right at the end of their tenure with you. We're talking about gratuity and the new fixed-term rules. Gratuity is an entirely employer-funded benefit. employees do not see this deducted from their monthly pay. Traditionally, for regular employees, unlocking this benefit requires 5 years of continuous service. When they finally reach that milestone, it's calculated based on their last drawn eligible wages, multiplied by 15/26, and then multiplied by their completed years of service. It's essentially a significant financial thank you for their loyalty to your school.
But here is an absolutely massive update under the Social Security Code that every school HR team needs to know. Directly employed fixed-term employees can now qualify for gratuity after completing just 1 single year of service under their contract. That is a total game changer for schools that rely on 1 or 2 year contracts for educators. But keep in mind, this applies specifically to direct fixed-term employees. That is a critical legal distinction from external contract labor supplied through an agency. You have to make sure you classify them correctly.
Which brings us to the climax of our explainer today, the new wage definition, and what we can call the 1 lakh rupee salary test. The new labor codes completely rewrite the math on a standard payslip.
Let's walk through a highly realistic monthly salary structure. Say we have a total gross of 1 lakh rupees. It's broken down into 30,000 for basic pay, 20,000 for HRA, 25,000 for a special allowance, and another 25,000 in other allowances. In the past, an HR team might just look at that 30,000 rupee basic pay and base all of their statutory calculations, like PF and gratuity, strictly on that smaller number. But under the new labor code framework, that approach is now completely obsolete. And here is exactly why that old method of just looking at basic pay completely fails now. It's the new 50% rule. Broadly speaking, if your excluded components, like the HRA and those special allowances we just talked about, exceed 50% of the total remuneration, that excess amount must be added back into the wages for statutory calculation purposes. In our 1 lakh example, the allowances total 70,000 rupees. That is well over the 50% threshold of 50,000. This means you literally cannot artificially suppress statutory wages by packing a salary with massive allowances anymore. The law catches it. This necessitates a complete top-to-bottom salary structure audit for your school to ensure you're fully compliant for 2026.
Ultimately, correctly applying these codes isn't just about avoiding state penalties. Payroll is the employee experience, and it's all about building trust through transparency.
Think about it. Your employees experience your HR department every single month when they look at that payslip. A compliance school ensures its educators actually understand the real difference between their cost to company, which includes your employer contributions for PF and ESIC, their gross salary, which is their earnings before their own deductions, and their net salary, the actual take-home cash hitting their bank account. When these terms get confused, or if a PF deduction is calculated wrong, trust vanishes instantly. Radical transparency prevents disputes and protects that trust. For schools looking to overhaul their systems in 2026 to meet all these new labor codes, there are specialized partners out there, like Teacher Pool, who offer comprehensive HR frameworks. They provide solutions tailored specifically to the unique ecosystem of educational institutions, ensuring your salary structures, compliance, and employee benefits are designed to protect both the organization and the educators who make it thrive every day. So I want to leave you with a final thought to really reflect on. When your teachers, your administrators, and your support staff look at their payslips this month, are they seeing just a confusing jumble of numbers, or are they seeing undeniably accurate proof of how much your institution actually values them? Getting payroll right isn't just a compliance exercise, it's how you care for your people. As the 2026 labor codes loom closer and closer, is your school truly ready for the audit? Thank you so much for joining me for this explainer, and I highly encourage you to review your salary structures today.